On today's Hashi, I'm discussing the Fed's dual mandate, existing home sales, and an increase in foreclosure activity for July. Today is Tuesday, August 20th, 2024. I am Byron Lazine, and the Hot Sheet starts now. Good morning. Welcome into today's Hot Sheet. Let me know in the live chat which market you are tuning in from. If you get value from the Hot Sheet each and every single day, as it is the only 24-hour look back on the housing market every single Monday through Thursday live on the internet, the only one that exists. If you get value from the show, hit the thumbs up on this live stream here today so more people just like you, agents of change in particular, can gain access to this information. If you're getting extreme value, go ahead and hit subscribe to the channel. Later on today here on the At Now Bam YouTube channel, we will have a new Real Word podcast, and there's a lot to cover on that. But let's jump into what's going on with housing, kicking off with the Fed and dual mandate. We've been talking a lot about the dual mandate. The dual mandate hasn't changed. In fact, Jerome Powell has recently been bringing up the dual mandate as a way to start to suggest that, we might be able to use some of this softening in the labor market to make our case for cutting the rate in September. He started using the dual mandate language last meeting and in the press conference that followed. We covered all of that right here on the Hot Sheet. We expect that Jerome Powell, when he speaks out of Jackson Hole with the fancy people on Friday, is also going to use the word dual mandate quite a bit, especially when we look at what happens tomorrow, Wednesday. We get that new labor information. And if there's a downgrade, a significant downgrade, like the post on X that we covered yesterday suggests. Lance Lambert covered this here recently on Resi Club. The Federal Reserve has their dual mandate from Congress. Of course, it's maximum employment and stable prices. Stable prices in the Fed's eye is 2% inflation. We're currently tracking at 2.9, lowest level since 2021. If you took out owner's equivalent rent, we'd already be there or below. That's what most other nations do, really all other nations that we would compare ourselves to. The Chicago Fed president, though, however, spoke to NPR this past Friday and suggested the central bank's focus could turn to the former, especially if the unemployment rate keeps rising. So now you're starting to see not just Jerome Powell use dual mandate, but his partners in crime starting to leak that information out here pre-Jackson Hole. Hey, if the unemployment rate keeps going up, we could see a case for cutting the rates. They're starting to leak that information here leading into September. Of course, September, still 100% chance, according to CME Group, that there's going to be an ease. It's only a 75% chance that it's a quarter point or it's up to 75%, and only a 75 rather that it's a half a point. Those numbers were flipped as recently as a week ago, but less feeling right now that it's going to go all the way to the half point. I think if you got some real downgrade on jobs tomorrow, like the X post that we covered yesterday suggests, that could change. That could flip in a heartbeat. It could be near 80-90% half point if you get really negative news on jobs. And they're starting to allude to that. If job flips, it gets closer to certainly to 5% unemployment. We're at 4.3 right now. When things start to go wrong in the job market, they don't tend to go at a slow basis. This is, again, that Chicago Fed chairperson speaking here. It tends to go up like a rocket and down like a feather in that space, talking about the job market. So it doesn't happen slowly, it happens fast. We've seen it go up from 3 and low threes on unemployment to 4.3 recently, softening of a labor market. But if we're heading towards 5, he's suggesting 4.3 to 5 is going to happen a lot quicker than 3.5 did to 4.3. It all of a sudden catches up, especially if you have downward revisions on job growth. Historically, unemployment rates start going up if temporary employment numbers go negative. temporary employment numbers. That's kind of a leading indicator. Okay. Other things that we want to be particularly looking for is how are construction jobs, are they pulling back? Because construction supports so many other, not just housing construction, just talking construction overall, supports so many other sectors. Okay. Somebody's got construction workers working on a project because they're investing in their business, right? You start to see these projects pull back. It's another indicator that not only the job market softening, but that the entire economy softening, which could lead to further job loss down the road. I mentioned last week that the Home Depot coming out after having a strong second quarter numbers that actually beat expectations. I mentioned that it was interesting that Home Depot would say, we're going to miss in quarter three and quarter four. They know what they're doing when they say they're going to miss. They know that the stock market is going to take a hit on that type of information. Hey, we're going to miss where we're expected to be coming up here in the next 2 quarters. They say, this is going to be something that, is due to an economy that's weakening, a consumer that is not spending as much, a consumer that doesn't have the money to invest in their home, even though they're staying in their home with the low interest rates. It's interesting. Now, all of a sudden, Lowe's is saying the same thing that Home Depot is. To me, this is an indicator that the economy is softer than we're being told that it is. Lowe's cuts their full year outlook as it expects weaker home improvement sales. Okay, so Lowe's also did what Home Depot did. They beat fiscal second quarter earnings expectations. Okay, but they missed on sales and cut its full year outlook. Okay, the CEO Marvin Ellison said consumers are waiting for the Federal Reserve to cut rates. The retailer's results came a week after Home Depot said they also expect this weaker second half of the year. So Lowe's and Home Depot, who deal directly with the homeowner, the consumer, are saying, and listen, the homeowner that they deal with has low interest, a very fixed low monthly payment. The majority of them, anyways, over 80% of them are under 5% on their 30-year fix. So it's like they're at 2.5%, 3%, 3.5%. The reason some of those would-be sellers haven't sold is because the rate is so low. There was an expectation, and I think this happened more last year than this year, that people would just invest in their homes, stay there for longer. Well, now they're not even doing that, showing signs again of an economy that could be weakening faster and maybe even further than many are portraying that to be the case. This is what you look at when you look at the jobs. And when you look at the Chicago Fed president, that's something that could happen very quickly and catch the Fed by surprise if they're not prepared for it. Okay, there are some various leading indicators going back to this discussion with the Chicago Fed president. Some of the leading indicators of a recession are starting to give warning lights. Okay. There are cross currents. The GDP growth numbers for the last quarter were a little stronger than we expected. So that'd be, GDP for second quarter being stronger than expected. That would be in the camp of, okay, maybe we're very strong. But remember, quarter one GDP was strong until it was revised downward. And we keep looking at these numbers in the rearview mirror. They tend to go down, not up, once they beat. The FOMC is going to meet again in less than a month. And the mission, they do this every 6 weeks. The Chicago Fed president talks about, hey, the mission is never done. We always meet every 6 weeks to make sure that we're heading or staying in the right direction. Obviously, Goolsbee, the Chicago Fed president, did not indicate how he would vote in September, but is certainly talking up signals that I think is going to vote for a cut when you start really talking about how quickly the job market can get out of control. Here's the dual mandate tracker. If you look at unemployment now up to 4.3%, highest level we've seen since the spike that we had during COVID, highest level that we've seen during, when you take out the downside of COVID here, and the full recovery from COVID. This is the highest level of employment this current presidential administration has seen. Their wish was obviously keep this thing around 3.5. You would have been hearing that during this, election cycle. This week's the DNC. You would have been hearing that throughout the entire week, that unemployment's 3.5. That's a really low number in comparison. Just looking here over time, near 50-year lows, or at 50-year lows in some cases, depending on the way you look at unemployment. Now being up at 4.3%, the highest of this current administration's run. Also, something that gets towards 5% will worry the Fed in a big way. Now, that also means that federal cut will come. Okay, that the 30-year fixed will likely go lower. And this is one of those things where I say, if you're looking for overnight, an overnight injection, an overnight medicine for high 30-year fixed rates, and that's what your buyer's telling you they're waiting for. They're waiting for unemployment to go up and go up quickly, which ultimately means people are losing jobs. Okay. The signs are pointing towards this rate cut cycle happening in September. Inflation continues to decelerate. It's getting closer to the 2% goal. We've gone from the 3.5 just last July to 4.3 in a year. The flags are going up for recession, and the SAM rule, SAHM, is in effect. I think 2 weeks ago, we covered the SAM rule on Knowledge Brokers Pod. You can go check that one out if you're interested in more on that. Over the past several months, Fed economists have changed their tone from inflation jawboning to labor market concerns. And labor market concerns, when they happen quickly, and the Fed will have to react. They'll if it happens too quickly. If we had a bombshell of a report tomorrow that ex post that we covered yesterday indicates that we actually missed job growth by 1 million over the last year, then you will probably hear Powell on Friday talking about a 0.5 point cut being all of a almost certainty in September. If you were to see something like that, we'll obviously see what happens tomorrow. The futures market, again, has that 75% chance of a 25 basis point. We covered that here earlier. Okay. All right. So here's looking at the dual mandate tracker in a different way. You have the unemployment and the inflation rate and the effective federal funds rate in there too, obviously at 5.3. If we look at times when it's been this high, 5.3, you had inflation there at 4.3, or I'm sorry, unemployment. If you go back to, we're going back to now, great financial crisis here. Before it really took off, you've got unemployment at 4.3. You have this 5.3 almost time frame of the effective federal funds rate. That starts getting cut, recession ensues, unemployment skyrockets. So you can see as unemployment goes up on this straight line, and we're bending towards a line. I mean, when these have bent around the 4% range, they tend to go higher. Okay. You can look at almost every point in the chart. When you've got this bending upward on unemployment that we have right now, it goes much higher. I mean, it could stop at 6. It doesn't have to go to 10 or 11% like it did after the great financial crisis, but it tends to not stop here. Okay. And I think that's what, the Fed is looking at. This line takes off here, gets up over 6. This black line, the federal fund, will drop quickly. They'll start cutting very quickly if that were to be the case, if unemployment takes off. And we'll see. We'll see what happens. All right. What does this look like for the housing market? Moody's chief economist Mark Zandi chimes in on that. Obviously, rates will fall further once the Fed's rate cutting cycle actually starts. Even just signs of, even signs of unemployment going up. You're going to see that rate coming down. As the Fed eases, bond market volatility will moderate and the yield curve will become more normally sloped, and thus prepayment risk in the mortgage securities will decline, resulting in narrowing the spread. Changes in the spread are largely a result of changes in investors' perceptions of the prepayment risk in the mortgage securities. Okay, changes in the spread. So that spread being larger between the 10-year and the 30-year than normal, it has to do with the prepayment risk in the mortgage security. So if you had the Fed easing, the volatility in the bond market moderating, you'll have a more normal slope on the yield curve, and that prepayment risk in mortgage securities will now decline, and that spread will also decline. So the spread is also very helpful to a lower 30-year fixed rate. Okay, you could have no federal funds rate cutting and an improving spread and still get a 30-year fixed that is lower. If the spread were to narrow to 2 percentage points, which is the average, the 30-year fixed mortgage, or the average at that point would be 5.91 on the 30-year fixed. That'd be right now instead of 6.49, just by getting to 2 on that spread between the 10-year and the 30-year, which is just under 2 is actually the historical norm. Okay. Redfin's got a report out, and let's jump into that now. Existing home sales and how they see them. Existing home sales, according to Redfin, rose 0.6% over the last month. They were actually the lowest July, though, ever on record. Existing home sales, lowest July ever. So the demand that seemingly would never go away in the real estate market has completely evaporated in these times of unaffordability. Sales of existing home sales fell 2% year over year, seasonally adjusted to an annual rate of 4.1 million in July. If I've got a seller looking to reach the stars on pricing, we know inventory is going up. We're going to hit the highest level we've seen since 2019. We're already there, but we're going to get back to some like 2019 levels here in just a month, and depending on which month you look at in 2019, which would be a more normal market than anything we've seen in recent memory. If I've got a seller reaching for these aspirational prices because they're looking rearview mirror the last couple of years, this is the information I want to bring them: the increase in inventory, the fact that existing home sales with that increase in inventory haven't budged, and we just went through the lowest July ever recorded. Yeah, lower than back during the great financial crisis years. You had better Julys back then. We have more population today. We have in fact, we have lower interest rates than some of those time periods back then. Sales of existing home sales fell 2% over the seasonally adjusted annual rate of 4.1 million in July. Pending sales down 3% month over month, 6% year over year, both of which were the biggest drops in nearly a year. Home prices were just 0.7% below the record high. So prices remain high, but they just don't. When you get inventory going up and you get this lack of demand, there are going to be areas where you're going to see price declines. It's supply and demand. You're going to get all this supply out there if the demand is still low, if the rates are still basically where they're at. Obviously, we've got some indications here that rates could be lower. That could help those markets. Okay. Nearly 60% of home purchase agreements were canceled, equaling 16% of homes that went under contract, highest percentage of any July on record. This is, again, all according to Redfin's data. There's a silver lining. The supply of homes for sale rose for a record 14%, and that's because of that inventory piling up. Okay, existing home sales falling to this lowest level ever recorded when it comes to July. Now, when you look at seasonally adjusted, you had May of 2020 at 3.9 million. That was a shock factor from COVID, obviously. If you go back to 2012, when we bottomed out, this is the lowest level of seasonally adjusted ever recorded, and we've kind of been there for quite some time. I mean, look at the demand here in the last year and a half. just completely fall out of the bottom of the residential real estate market, which also means this is usually the floor, 4 million. We have never really seen it go under this level for any extended period of time. This means you're only going to go up from here in terms of demand and transactions. It's probably, I mean, I look at these next 4, 5, 6 months, through basically July, or I'm sorry, through January. From now through January, you get past election, you get past all the major holidays, you get past a presidential inauguration, all this kind of stuff. This is a buying window. And you might have, and this is a buying window for investors, for buyers, people that are interested, obviously, in getting more real estate in their portfolio, whatever the case may be. This is an opportunity. You're going to start to see the rate come down, but as it comes down, some people are going to say, I'm waiting for it to come down more. It's winter, it's holiday, it's uncertainty, it's whatever. Sit on the sidelines drinking Gatorade, while the players are going to realize this is the opportunity to negotiate. Okay, you'll get a little bit of help on that rate, but you're going to be able to come in on the winter timeframe where you do have some of these stale listings, some of these sellers who are really looking to sell. This is a buying opportunity. Prices should be higher in the future than what you could get in this 5 months. They're going to be higher in the rearview mirror, I believe. They're going to be higher in the future. This 5 months, to me, is an opportunity for those prices to work their way down, the ones that actually sell, to something attractive to somebody who wants to go out there and negotiate. Here's some more July 24 housing market stats. Median sale price year over year, 4.1% up, 439,000 plus. Again, the existing home sales are down just over 4 million. Pending home sales down month over month, down year over year. Homes sold, that's up month over month, 0.2% changed on closings, but down 1.6% year over year. New listings is up 2.9% on the year, on the annually adjusted. Total homes for sale up 14% seasonally adjusted, as mentioned before. Months of supply now 2.6. That's up 0.3 months of supply, much different than the NAR number, which has got us closer to 4 plus. But months of supply, according to Redfin, remember, their metric on an even market is 5 months. NAR historically has gone with 6. Median days on market 34, up 2 month over month, up 5 days year over year. Shares of homes sold over final list price, you got about a third of those, both down though, month over month and year over year. Okay. Here's the home purchases that fell apart at the highest rate ever recorded in a July. Okay. Only matching those early months of 2020, or really only matching one of the early months in 2020. As people were dealing with COVID. All of these charts, by the way, available for you inside of BAMX. Our BAMX members get all of this data, all the charts that we share, as well as all of the hot sheet show notes each and every single day inside of BAMX. Use code HOT to get 10% off. So you get access to the show notes, which people are using in their communications. Agents are using, agents of change, that is, in their communication every single day, as well as all of the slides from the show. We also drop new monthly courses. We have live streams each in our office hours, each and every other week, the community. And every Friday, we take this information and build out done for you content, social media templates that we deliver directly to you, as well as email scripts, video scripts, and blog scripts, all sent directly to you each and every Friday. Use code HOT to get 10% off of BAMX today. And let's just take one final look here at some locations here on this Redfin report. Median sales rose the most. Brunswick, Detroit, Newark fell the most. Austin, Dallas, San Antonio. Pending sales were up in San Francisco, San Jose, Newark. Fell the most in Houston, Minneapolis, Atlanta. Closed homes were up San Jose, San Francisco, Providence. They fell in West Palm, Detroit, Austin. Active listings up Tampa, Cincinnati, Fort Lauderdale. They fell in just one metro in Chicago. New listings up 20% in Providence, 20% almost in San Jose, 18% in Vegas, fell in Atlanta, Portland, Houston, and sold above list price. That's Newark, San Jose, Nassau County. Lowest was West Palm, Miami, Fort Lauderdale. Miami Florida rather, with the inventory seeing those prices obviously take a hit. All right, let's take a look at everyone that wants to compare 2008 to today. Yeah, we could be entering a recession. Those signals that we talked about earlier in the show are flaring up, but we're not entering anything that quite looked like 2008, despite there being headlines that might scare some people into believing that. Headlines like this: U.S. foreclosure activity sees a monthly increase in July 2024. But you have to dig deeper to really understand it, okay? Adam, ATTOM, a leading curator of land, property, and real estate data, released its July 2024 U.S. foreclosure market report. Shows that there were a total of 31,929 U.S. properties with foreclosure filings, default notices, scheduled auctions, or bank repossessions. That's up 15% from a month ago and up slightly by 0.2% from a year ago. Okay, so 15% from a month ago and 0.2% from a year ago. What do you think mainstream media is going to run with as a headline? I know what they'll run with. 15% up on foreclosures. July's foreclosure up 15%. And they're going to reference the month over month number, get everybody really scared and frightened. And the reality is we're just now entering normal foreclosure levels. I did an interview with Stacy Sutter here on the YouTube channel recently over the summer. He used to be the number one REO broker in Houston. Now he feels like there is a foreclosure boom looming. It's not showing up in the data right now, but one thing that he does talk about there is that there is a normal level of foreclosures. There is a level that just has to happen. We got way too low for too long because we weren't allowing foreclosures. Some of these, having foreclosures in the market is still a healthy thing. Just because there are some level of foreclosures does not mean that is a bad thing. It means the system is working. July's foreclosure activity reflects a slight shift in the housing market. Rob Barber, CEO at Adam, with 18% increase in foreclosure starts and 14% rise in completed foreclosures from last month. These shifts may highlight growing pressures in certain areas. However, soaring home prices seem to continue to spike, which obviously boosts equity and gives people the opportunity to, not go into foreclosure. Here are the areas where we're seeing the highest foreclosure rates: Nevada, Utah, and Delaware. Okay. The greatest numbers of foreclosure starts would be California, Florida, and Texas. Okay. Obviously Florida and Texas, seeing a lot of building, big boom there on building. And to me, it would make sense that you might see some of those. Now you also have a lot of cash buyers in both of those areas, particularly in Florida. And, we'll have to continue to monitor that as we go through. Here are the foreclosure starts right out of the hot sheet show notes. Based on the numbers, states with the most foreclosure starts, again, California, Florida, Texas. You're in the 2000s there. Illinois, 1,200, and New York, about 1,200. Foreclosure starts in major metro areas. 1,200, 1,500 Chicago, 1,200 New York, 782 in Philly, 758 in Miami, 689 in LA. These numbers are very small. These aren't huge numbers. Here are the most states with the most REOs. So like they've actually completed the foreclosure process. 377 in New York, 370 in California. These numbers are so small. I mean, you throw 370 homes into the inventory bucket in New York, it's like throwing a pebble into the Hudson River. It means nothing. So they're up. Don't let the mainstream media headlines of showing them up, create fear and uncertainty that shouldn't exist, because those numbers just haven't gone up enough to really have any concern about them. 10-year is coming in at 3.841 here as of today. The 30-year fix dropped down a little bit on that declining 10-year, coming in at 6.53 to end the day. according to Mortgage News Daily. We'll see where that goes today. We'll update again, obviously, tomorrow morning, as we do each and every single Monday through Thursday that the markets are open, right here on the Hot Sheet, the only place on the internet that does a 24-hour look back on the housing market, the only live housing show existing on the internet today. Hope you enjoyed. If you got value out of this, hit the thumbs up and the subscribe down below. If you're an agent of change and you want to take your business and all the information that you're bringing to consumers and clients to close the knowledge gap to the table at a higher level, join us at BAM Mania in Las Vegas. BAM Mania, October 17th and 18th. The 17th is for VIPs only. VIP tickets are going to sell out soon. They will sell out first before general admission. Make sure you go to bammania.com to lock in your spot. At Circa Las Vegas, it's a brand new venue. They've got the Stadium Swim. We're going to be doing something at the Legacy Club and Stadium Swim. Going to be an unbelievable experience for those that can attend. If you are a BAMX member, you get 25% off of BAM Mania. So use your personal code to lock in that 25% off. bammania.com. Kevin, thank you so much for the kind words there. Really appreciate that. Laura, cannot wait to see you in Vegas. And the hotel is, in fact, insane. Quite the venue. We're actually pretty lucky to have put this all together. You know, BAM's got to get a little bit of luck once in a while. We got a lot of things, a lot of resistance for the agent of change movement. I don't know why, but that's more of a legacy mindset. We know if we're going to be different and lead in this industry, we've got to be that agent of change. All right, there you go. There's your hot sheet. I will be back here on the main channel a little bit later today with a new Real Word podcast. So stay tuned, obviously, for that. I'll see you over there. Until then, of course, toodaloo.